whole point of this conversation is to kind of talk to you all as wealth advisors in the context of your business owner clients. So folks who own a business, especially in the mid-market, tend to see that a large amount of their wealth is tied up in this illiquid asset known as their business. It could be a family business or what have you, but sometimes upwards of 90% of their wealth might be tied to this asset. And as wealth advisors who are very well, seasoned with the idea of portfolio theory, obviously this can be a little bit of a complex situation as you're looking to navigate your clients' wealth and the risk associated with it. So what we're here to talk about today are some of the concrete steps and things that your clients can be thinking about as they think about how do they maximize the overall long-term value of their companies while also minimizing risk. So I think we have a poll to start out with. Carlos, if you want to share that, which is right now, do you engage with your business owner clients around their ultimate company exit? So we have a couple of answers for this. Absolutely. All right, we've already got one there. So we'll let you guys have about 15 seconds or so to answer these questions, and then we'll show the results. Okay, I think we already have it already answered. Great. All right, that's what we wanted to see. Absolutely. Most of you are saying that you engage, as part of the financial plan as you work with them kind of throughout their lifetime. That's great to hear. A couple saying that, they engage closer to the point of liquidity. I don't think that that's all that surprising. One of the things that I certainly see as an M&A advisor working with companies is that it's surprising sometimes how little time has been spent with business owners really getting their affairs in order so that they have a true wealth plan for an exit strategy. So it's good to see that a lot of you are being proactive with that and helping protect your clients. So hopefully this will be a helpful discussion with you all today.
And just to add a small piece of context here, and where we see that synergy is larger exits lead to larger AUM, and obviously that's advantageous for those in the wealth management field that are so often compensated by managing a larger pool of wealth for their clients.
Yeah, and as we tend to see, business owners who don't have those plans in place tend to be, not the happiest about the outcome that they achieve in a sale process because maybe too much of that check that they get ends up with the IRS, which nobody wants, or at least very few people want. All right. So as you all know, to the extent that you're working with business owners on a daily basis, high achieving business owners tend to be a bit of a rare breed. It can sometimes take a very delicate touch to provide, the guidance needed to make sure that they're getting the advice they need to maximize their best interests, whether that's value, risk, et cetera. I know that a lot of times what I hear from wealth advisors is that you can talk to a client for 3, 4, 5 years, and it takes that long for them to finally make the change that they really need to do. Now, it's one of the things that we think about around the business, like I said, is, given that mid-market companies tend to be illiquid and tend to be a sizable portion of clients' overall estates, it adds a wild card to the planning process and the ability to kind of manage risk and manage upside on value. And so what we're here to talk about is how advisors like us, how folks like us can maybe help you to see some of the tools that you use today by your clients to maximize their value over the long haul. So as tech support mentioned, as Cindy mentioned, please don't feel timid to ask questions. Please use the Q&A function down below to the extent that anything pops up throughout the discussion, and we'll be happy to answer those questions as we get time in today's presentation. All right, now we do have one more question that we want to do another poll just to see what you all think. which is around value. Give that a second. So what is the number one driver of business value? Is it profitability? Is it growth, scale, or competitive positioning? Okay, we're waiting on a couple more people.
You're gonna see a much wider spread here than our first question, Derek.
I see that. I see that. Okay. I think it's 100% answered. We can show the poll now. All right. So a little bit more just diffusion here, and that's not surprising. 14% with profitability, 57% on growth. That's interesting. Nobody said scale, and about 30% competitive positioning. So it's probably no surprise. It's a bit of a trick question, right? So value is tied up into a lot of different metrics, a lot of different things that ultimately come down to what a business is worth. And, you know, the popular saying is it's worth what somebody's willing to pay, right? And a lot of these factors that you're seeing here, whether it's profitability, like EBITDA margins or gross margins, growth trajectory, you know, is it growing 10% year over year? Scale, how large is the business? You know, do they have a competitive moat in the area? Do they own IP that makes it differentiated? All these things impact value at the end of the day. And hopefully we're going to get to some things in this conversation that'll help you see how your clients could hopefully, you know, augment these items to maximize that ultimate valuation at an exit. So, all right, moving on. So Steve, I think I want to start with you. And, you know, I know that every time when we at DAC begin working with new clients to prepare them for a sale process, we're always starting with deep dive assessments of the business. And we're always looking to bring that outsider's perspective to the client so we can best position them for how a buyer is going to look at an opportunity. You know, that plays its way into our marketing materials and how we actually go to specific buyers. I know this is very similar to how you handle businesses as an outside consultant. Can you kind of kick us off and talk about how you work with mid-market business owners to kind of bring that perspective to their business?
Yeah, sure. If you allow me one housekeeping item, I understand that some people, there's some confusion about when the call ends. The call goes from 11:30 to 12:30. So if you're planning your day. Having said that, sure. You know, I think today there's several things I want to talk about as far as early stage preparation for an M&A event. I think I want to start though by explaining the work we do at CEG Partners in a little bit more detail, maybe for 60 seconds, and how it intersects with today's topic, maximizing market value for sellers. So as you can see, we generally operate in 4 areas of what we call commercial operations. The first is go-to-market strategy and execution. So this includes helping companies determine where their products or services should appear, how to compete, including the business model requirements, and what they'll get from it. A significant part of this is also working with distribution partners on behalf of a manufacturer to align their operating profiles and strategies with what the manufacturer is trying to accomplish, with the manufacturer's business objectives. So another area of focus for us is strategic positioning for growth. We're going to look at an example of this shortly. However, at its core, this includes defining and prioritizing a company's strategic options, selecting and entering new markets or businesses, diversifying for growth and risk reduction as an example, identifying or bringing on a new revenue stream that may run on a different economic cycle than an existing business. And it also includes on the buy side of M&A, planning and integrating commercial operations. The third bucket for us is professionalizing commercial operations and scaling. Again, we'll touch on this as a sales side strategy further into this presentation. And finally, we work with pricing, which is probably the single most efficient determinant of a company's profitability, and by extension, its market value. Pricing is a big topic, but Nessus, our work here focuses on 3 areas. Establishing a culture that responsibly maximizes price as part of its DNA, identifying the right data and analytics for making great price decisions, and establishing processes that ensure good price governance, and that a company's actions show up at a net realized level, meaning if you raise prices 6%, you want to see 6% at the profit line. Okay, let's change slides. So in case you haven't heard it before, there's an old saying in M&A, explain the past, sell the future. So my contribution to today's program is around selling the future, making your broker, investment banker, and ultimately your buyer comfortable that, that there's a clear and wide runway for post-acquisition value creation. Another way to say this is, buyers want to look sellers in the eye and see people who really understand the existing business and have a well-formed view of the unrealized possibilities.
And Steve, I just want to, echo this point with you a little bit. And one of the things that we see with our clients all the time is that they've been operating the business and stuck in the weeds so much that they haven't had somebody to help them look at it in a different lens and say, what is achievable, over the 5, 10, 15-year horizon. And I love this slide for you. This is great.
Great. I was going to take a poll here, but I think I'm going to go a little bit farther, then we'll jump into another poll. Feels like we just had one. So can you go to the next slide? So with that in mind, let's break this down into what I'll call 3 operational imperatives for achieving this and your clients securing a high multiple for their business. The first is having a strategic position that excites. Second is being able to prove your growth potential, and third, having a professional commercial operations team that can scale as the new owner leads into the growth potential that your client's saying is there, right? So these are the folks who, after all the smoke is cleared, are primarily responsible for delivering post-acquisition value creation for the new owner. So we really have to impress in this area. Let's go to the next slide. So we're going to start off discussing strategic positioning, but first, let's compare market positions to strategic positions. Most lower to middle market firms we work with, lower to middle market firms we work with, initially believe they have a clear strategic position, but in fact, they have a clear or mostly clear market position. This works for daily competing and decision making, but it carries less impact in M&A. In M&A, premium buyers want to see an achievable path to something greater, and they want to be able to predict its value. So, sorry, I just had a glitch. So real quickly, a market position is a market-specific concept that focuses on how a company competes within a certain segment, considering factors that affect its ability to compete. A strategic position is a broader concept encompassing a company's overall strategic direction, competitive advantage, and addresses how it will create value and differentiates itself and its long-term goals across multiple markets, segments, and potentially industries. Okay, so so having made that distinction, let's go to the next slide. So let's take a look at an example of strategic positioning. So for the purpose of illustration, I'm using a current CE2 customer profile, loosely. The overall chart we're looking at represents their broader industry, public works, equipment. It represents the industry structure and where they fit, represented in orange highlight. As you can see, they occupy one segment where they focus on one application with 3 products. and this is a business well over $100 million. They are essentially there. So this is essentially their market position, and this is where they are experts. So one point I really want to understand, a double score, it is critical for your clients to have an in-depth understanding of the broader industry when meeting with investment bankers and buyers, because this is where the growth is going to come from. So let's go to the next slide. Know your adjacent opportunities and how they work. This view illustrates the client's potential in the broader industry or the unrealized growth opportunities. By blowing out the other three segments and assuming each has an equal number of applications and products for those applications, so the yellow areas, that yields a market potential of 3 additional segments, 15 additional applications, and 77 additional products, compared with where we started at one segment, 1 application, and 3 products, right? So by accurately defining the structure of the industry, we create a very wide runway for growth for this business. Next slide. So, however, while most companies don't have this perspective on hand, and this kind of assessment we just looked at itself is still a bit academic. I mean, it can be pulled together relatively easily by people who know how to get and organize the information. It has M&A value for sure, but not as much as it could. Where the real value comes when your client understands the true nature of those adjacent opportunities and can determine which deserves a deeper dive, and can accurately prioritize the best opportunities based on their economic and strategic value and the effort it's going to take to win. So, in essence, making them investable either through organic initiatives or through acquisitions or partnerships. Okay, so that's kind of the cascading of the strategic positioning, knowing your industry structure, where you fit, looking at all the adjacent opportunities and deciding which one of those adjacent opportunities are worth a deeper look, and getting down to a very intimate understanding of how to succeed in those markets, what it's going to take and what you're going to get from it. That's good growth talk when selling your business. So let's go to the next slide, Derek. Let's look at proving growth potential. And then actually, let's stop here and do the poll, Derek.
Okay, so this poll from Steve is, what's the primary role of a wealth advisor or wealth manager with a client in selling their business? Okay, I think we have them all. So Steve, it looks like most people are saying it's about providing strategic guidance on when to exit the business, with an equal mix between minimizing tax liabilities, one of my favorite topics, and maybe identifying potential buyers or investors.
Okay, well, good. Well, then this is a good topic because I think we can get them a little more focused on helping those clients maximize price. So we just walked through the strategic positioning, which shows where the growth potential are in the business. So now let's talk a little bit about proving growth. So proving growth potential from the commercial operations perspective is number one, having a clear strategic position that leads to a larger addressable market over the next 5 to 10 years. So we just walked through that through the 3 slides we went through. We got from a market perspective, a current market perspective, to a strategic position that took us to a much larger addressable market. Presenting prioritized growth opportunities that are deeply understood and supported with fact-based data and reliable projections. I think too often owners believe that they can kind of float their way through this discussion using maybe anecdotal stories about growth opportunities, or dusting off a 3-year-old strategic plan. But this is really getting into the details, developing fact-based data that an educated, sophisticated buyer, whether they're in your industry or not, will walk in and look at and say, you know what, I believe that. I think that growth opportunity is there. You really helped me see how to execute. You show me where my risks are, and you show me what I'm going to get out of it. So now I can start thinking about that value when I'm pricing your company. Next one, ensuring.
And Steve, just real quick, as an investment banker, I'd say that we're seeing more and more, especially at the higher end of the mid-market and those $100, $200 million type businesses, that buyers are really expecting to see and hoping to see these types of studies that will help kind of underpin the whole business and the business plan.
Great. Next one, ensuring go-to-market resources are aligned with the best opportunities. It doesn't do you any good or your clients any good to go in and talk about these growth opportunities. But when you look how the commercial operations group is facing off today, they're not facing off with these growth opportunities. They're not top of mind. They're not putting investments towards it. Another part of making sure that your resource aligned is shedding underperforming investments that are consuming working capital or constrained growth. This could be markets that are tertiary or not profitable. This could be product lines that are tertiary. It could be people that are in jobs that are in investments that are underperforming what you really want to sell in that business. And then the last one, demonstrating that commercial operations are optimized with the right people, processes, and tools for post-acquisition value creation. So this really means that, well, starting with leaders, including commercial leaders. So the guys running the commercial operations, when that buyer comes in, that owner needs to put someone in front of this owner that can convince him that this sales leader or this commercial operations leader has the ability to, number one, conceive strategic initiatives, and number two, execute on those initiatives. And that ability cascades down through everything that commercial operations owner owns and does, all the way through his department. So that's 4, I think, fairly good points about proving growth potential. Let's go to my last slide here, Derek. Give me 1 second.
Yeah, well, and just to augment that point just a little bit, talking to buyers every day, the question around management team and making sure that a buyer isn't about to spend $50 million on a company and then see all of the management team walk away. That's a very important factor that people are looking at, and many times it's about not just the business, but do they believe in the management team? Because obviously that's a very different underwriting approach if you need to come in and replace the senior executives within a year or so of a transaction.
Okay. We discussed strategic positioning for growth, and then we've talked about proving the value of that growth. We've only brushed on scalable commercial operations, which allow the best growth opportunities to actually succeed in implementation. Again, these are the primary resources for delivering post-acquisition value creation for the new owner. Here are some characteristics of a professional, scalable commercial operations team or organization. First, again, they have a strategic focus. So they understand the big picture, and it's supported with projects and initiatives. Second, scalable leadership. I touched on this in the last slide. go-to-market leaders who understand and can speak to the unrealized opportunities in the business, their characteristics, and their value. This ability to, or lack of ability to, really comes through in the buyer presentations, right? The buyers want to know where the growth is. And if your owner, or is, first of all, hopefully he has a designated person to stand up and leading his organization that's going to continue with the business, that can talk to this when owner leaves. But it won't take long for a buyer to find out that this guy really knows his stuff, or he really doesn't know his stuff. It's just assumptions. It's conclusions based on assumptions rather than fact-based data. Scalable revenue models, right? As our business grows, as we become more diversified, our pricing revenue models designed to accommodate that growth. Flexible infrastructure, the ability to flex according to the needs of the business, market conditions, and new opportunities. A lot of times in business, you'll see a very rigid, and particularly in the commercial operations that house the sales and the marketing and all that, you'll see very rigid systems that aren't able to flex. If most buyers want to buy and scale, and to do that, you have to have flexibility. Technology and tools, automation, improve productivity, enhance customer management. These are all things that, particularly if I'm a financial buyer and I'm looking for a platform company, which I'm probably going to pay more for than in any other scenario, these technology and tools really need to be in place, because I'm going to be out there bolting on companies for the next 5 years, and I need to know that this company can take them on. And then finally, I think probably the most important, professionalized commercial operations and scaling is organizations, that decisions are being driven by data and expert insights. So that's really what I had for my area of content here. But in closing, if there was one last thing I could leave you with that you should counsel your you should use to counsel your clients, is that this work requires, this preparatory work begins very early in the process. It requires good data. It requires experienced insights. And more than anything, it requires time, right? This is not something you throw together in 30 days before you call the investment banker in. Premium buyers will know if your assessments are based on verified assumptions. If they'll know if your assessments are based on unverified assessments. If they are still interested after that, this puts the burden of proof on them, which slows the sales process, introduce risk, because you have no control over what they will uncover when they're out there snooping around in your industry. And ultimately, this reduces the value of the client's business. So that's all I had, Carlos.
Yeah, that's great. And I love the segue or your last point being about data and expert insights, because I think that's certainly at the forefront of what a fractional CFO can bring to a business in this type of transaction. So as I mentioned, our sweet spot is privately held companies, generally family owned, between 5 and 200 million or so in revenue, and love working with them for years. Have one relationship that predates my time with Pro CFO. We've been working with them for now 4.5 years, help them evaluate acquisitions, help them elevate their finance and accounting operations, and overall play a key role on the leadership team for that business. As a firm, again, we're 45 CFOs. My background was originally in investment banking, then moved to the investing side, have been a part of a number of businesses that have started, that have acquired other companies. So I feel like I'm pretty comfortable in this vantage point of both being a CFO, as well as understanding what's happening with the other players like Derek and the investment bankers, as well as the advisors that are going to be helping in the process, and also what buyers are looking for, and being ready to anticipate their informational desires and requirements. One more small overview of how we work at Pro CFO. this diagram really just helps us organize our thoughts and create momentum when we're working with a company. It doesn't always have to go in order, whether we're focusing on the revenue model in the lower right. I think that revenue model certainly ties into what you just heard from Steve and the market opportunities and even how different companies are charging for their services and how that can change over time and doesn't always have to be industry standard. I think we've certainly seen a number of businesses prioritizing day two revenue, adding day two revenue, emphasizing recurring revenue models. But that can certainly be a transition point from Steve's work to what we're going to be doing on just that spoke of the flywheel. And from there, needs to tie into everything that is happening in the F&A department and strategically within an organization. So make sure that the goals and strategies are aligned, that they have systems and processes and reporting, because as we're going to see that in a couple more slides. If you are unable to produce the numbers and have the data, it's going to be a really bumpy process. And as Derek will tell you, there aren't many mechanisms to de-risk, and the primary one that a buyer will do to de-risk is lower the price, and that can be very challenging both from the process standpoint as well as with the business owner to face that decision mid-process. But I think this is a good visual of showing some of the different areas within an F&A department that we can add value to.
I mean, Carlos, that slide is really a great starting point for a conversation, right? With clients around, can you tell me more about these areas, and do you feel good about where you stand today?
Yeah, absolutely. Thank you, Derek. This slide really just is tying together the gray box is Steve, and at the top that expert perspective somebody might bring in, and that's that strategic preparation. It transitions to a blue box, and that's where we play, and that's not only the role we might have coming into a business, maybe elevating what financial leadership they had, which might have only been a controller level. We've even worked with businesses that I would say didn't even have a controller, senior bookkeeper with a little bit of outside tax support. Nobody in the business really adept at the numbers, the data, the systems, the processes, and what rigor is going to be expected in due diligence. And then that preparation and that numerical foundation, if you will, sets up what's going to happen as we get to Derek in this transaction execution phase with bankers, tax advisors, and due diligence. I was recently at a conference, and the founder of Axial, which the investment bankers will know very well, probably one of the top portals and connection places for acquirers, both strategic and financial, and business owners and intermediaries to come together and share deal information and opportunities. And based on a recent survey from them, about half of transactions that had an LOI, so somebody, a prospective buyer, had written an offer that had key terms there, and those didn't close. They did not reach completion. And here are a few of the reasons that tie to our world that are avoidable mistakes. And it really comes down to having strong financial reporting, that the numbers are believable, that they're familiar with them. It's one thing to create a P&L with a single line of revenue, which satisfies auditors, but prospective buyers want to understand, well, where did that revenue come from? What types of revenue is that? Not all revenue is equal, as you heard You mentioned before the emphasis on recurring revenue. That is a huge premium that buyers have continued to value and pay up for. And I'm sure Derek and the other investment bankers would love to sell more businesses with more recurring revenue. A simple profit and loss statement isn't going to have that, and that familiarity with the numbers needs to be there from both management and the financial leadership.
Well, yeah, I mean, it goes a little bit beyond that, Carlos, and that buyers are kind of demanding a higher level of data in the transactions that they're looking at, because one thing that we've seen over the last, call it year and a half, is in this inflationary environment, people are wondering, well, is your revenue really growing, or is it just price increases? Are what's the price to volume analysis? Are you selling more product, or are you actually in a declining business? And a lot of that stuff can get hidden if you don't actually have that connection between your data and your financials.
Yeah, great point. Thanks for jumping in there, Derek. Just sort of offer a couple of other benefits, even outside of necessarily the deliberate preparation that a business and an owner might be going through in getting ready. It certainly helps with the decision making that is going to happen in the business if there's stronger financial reporting and information. Being prepared if an opportunity just presents itself, not being able to respond quickly and competently and professionally, it could be a huge missed opportunity for certain business. And as Derek might describe in some of his process related materials, once a deal starts, it's really hard to pause it credibly. It's kind of a train that needs to keep moving, especially once the buyers are engaged. I know this one's a little bit busy, but just want to pick off a few items that I've done. So as a firm, this would be even broader, but that I've done with some of the businesses I've worked with in the last few years. And that could be everything from implementing NetSuite and going from a horrible, outdated GovCon software that they had that was off maintenance, that produced the ugliest reports, that were really lacking usable information, and all of the Excel and outside tracking that we had to do as a business. Getting that to NetSuite, hugely valuable. That's what the new owner of that business expected. Working with owners and managers as they prepared for a transaction on the goals and strategy, and one of their goals and values was rewarding employees. So we implemented a stock appreciation plan so that as they prepared for an exit, the employees that had been there the longest and that had contributed to the most would be able to participate in that upside and in that exit event. Cash management has been another area that's hugely important, and I think getting a lot more focus as businesses are now having to deal with interest rates that might be double where they were. So that cost of working capital, when it was 5%, not as big a deal as now it is at 10% or maybe even more. So being really judicious and aggressive of where we're allocating that working capital is top of mind for a lot of owners, and I think differentiates what's a good business from a great business. So I'll do my poll at this point as we transition topics from sort of what can be done to enhance the value of a business to proving that out before a process launches. Excuse me. I hit the wrong one. Go back. Launch. So as it relates to what is a Q of E, and are the wealth advisors here familiar with Q of E's? Do they associated as the Queen of England? Is it something like an audit light analysis? Who does them? Is it Big Four firms? Is it your local CPA? What do our wealth advisor audience know about Q of E's? Let's give folks a few more seconds. Okay, so pleased to share that the audience knows that it's not the Q of E is not the Queen of England. It is an audit light and analysis heavy report. And let's go to the Q of E slide. I think the Q of E plays a couple of important roles. One is in diligence and helping the buyers and acquirers get comfort, but also heavily used for their financing and the credibility and the numbers that the bank is relying on, or other investors that are supporting the transaction have faith that the financials have been verified, that they're of high quality, and that certain practices that are very common in a family held, closely held private business that doesn't have a lot of debt might not be adhering to GAAP in the strongest way, that somebody's looked at it and made some of the adjustments for the financial rigor that they may have in a new lending situation. Most of this is going to be done looking at the last 2 years. We'll sometimes see a roll forward for a last 12 months, which is obviously driven by banks and their ability to lend on an EBITDA of the last 12 months. The cost can be significant, but I think there is value there in consummating a transaction and being prepared for it. So while the range could be anywhere from 25 up to 250,000, depending on the size of the business and the complexity, it moves the process along and takes time to complete. So doing it on the front end and where the seller has the onus, this is sort of switched. It used to be much more common that the buyer paid for it. That's shifted to the seller and being prepared for that transaction. Other benefits of getting a quality of earnings done is it'll help tell the story for the company and provide additional numerical backup of how it's trended over cycles, over different months, whether there were special events or changes that happened within the business. Looking at these last 3 years, the COVID tailwinds and headwinds, trying to normalize for those and quantifying those, that's not something that an audit is gonna pick up. Audits are really good at covering internal controls and focusing on an end financial statement that's complete. This is less about the internal controls and more about the analysis that buyers care about to predict the future and manage it. And then the last piece that I'll mention is when it comes to the smaller deal points that are unfortunately sometimes overlooked early, like working capital and what's the working capital adjustment, going through looking at the last, say, 3 years, really understanding all of the accounts that are in working capital, what things have happened to affect those balances over that period, makes the negotiation much easier, because millions of dollars can get tied up and in dispute in a transaction just based on the discussion of, well, what's the right level of working capital. So with that, transition to you, Derek.
Okay. So I guess let's just stay on this page for a second because quality of earnings is a near and dear topic to my heart as we think about selling businesses and working through all of that. I had a client recently who went through the quality of earnings process, and the CFO who was working with us, through that process, we were using a mid-sized, regional accounting firm to do it, and she told me at the end of the process, Derek, that was extraordinarily painful, but I can't imagine doing that if it was the buyer driving the discussion, right? Because at the end of the day, the best time to do this kind of deep dive financial assessment is ultimately when you're the one paying the bill and you're the one who, the advisor is actually your advisor. It's just a much more friendly, easier way to have the conversation as opposed to when it's the buyer who's then going to be focused on getting that EBITDA number as low as possible, as low as they can argue for to hopefully, pay the least price that you can. So it's always good to have somebody in your corner or in your client's corner who's kind of that arbiter third party with a nice reputation that they can stamp on your financials saying that these are accurate, these are sustainable, and these are something that you can actually bid off of, which for us is the key, right? Is that we have an EBITDA that we can stand behind and take to market, and buyers can say there's credibility. Because unfortunately, at the end of the day, as an investment banker, nobody just trusts me at my word. We need to be able to prove it, just like we've been talking about with Steve and Carlos. Data is important. Being able to prove the business is extremely important. So let's go to the next slide, Carlos. All right. So I guess I'll do a quick little thing on DAC while we're here, the mid-market maximize. So DAC, we're about 30 investment bankers headquartered in New Jersey, New York area. But then we have folks in New Jersey, Philly, South Florida, Chicago, LA. We're kind of all over the country. We've done 750 transactions, $8 billion of transaction value. Our typical clients are family or founder-owned businesses between, call it 20 and $300 million in revenue, something like that. So I thought that instead of digging into a sell side process for you all, because at the end of the day, when a client's ready to sell, that's not when I want to talk to them. I do. Don't get me wrong. I still want to talk to them. But I would much prefer to talk to them well in advance of the sale process, because at the end of the day, as an M&A advisor, there's kind of a limit to what I can do and how much influence I can have on the positioning of a business, 30 days before launching a sale process. So what we do with a lot of our clients is we do what we call a strategic alternatives review. So I figured I'd kind of go through that a little bit and talk to you about what that means and kind of how we use that with our clients, because I think it provides a valuable framework for how you can think about your clients' businesses and help them think through some of these exercises. And it really starts with a deep dive on diligence. So we're really starting with, what makes your business tick? How are you making money? How do you work with your customers? Do you have customer concentration issues? What's the basis for your financial performance? Why did things move the way they moved in the past? Do you have growing gross margin? Do you have shrinking gross margin? Is it raw material prices? What's really driving your business over the historical period? And then how does that actually work with your projections, right? And ideally, somebody like Carlos, somebody like Steve's already been in there. So there's a thoroughly vetted business plan. There's already a lot of these details behind it. But this is where we really poke and we prod and we try to come to an understanding of what at the end of the day is going to drive your business forward and hopefully, get maximum value in the marketplace. To the extent that if somebody like Carlos is involved or Steve, hopefully there's a projection model in place. If there's not, we help build a projection model that we think would stand up to scrutiny with buyers. A lot of our clients, have said that, working with us through this process has really changed how they think about planning their businesses, really looking at unit level economics and how that drives your economic forecast. And then finally, kind of like, where do you sit within your industry? What are your competitors look like? What do their margins look like? How does that actually, show, are you leading the industry? Are you lagging? How does that impact ultimately your multiple? And And that brings us to kind of a SWOT analysis. Do you have customer or vendor concentration? What are the dynamics in the industry? Is it a, industry that's in secular decline? Is it a booming industry with a lot of tailwinds? What are the components of your revenue? Is it recurring revenue, like Carlos stated, which is highly sought after? Is it reoccurring revenue, which is a term we like to use, if it's reoccurring but not truly contracted? What are your organic initiatives? Has Steve helped you come up with a plan to take this from, a one-legged stool to a three-legged stool? Have you already started to get that, that momentum? And then what does your corporate infrastructure look like? Again, the things that Carlos talks about around your internal financials, your clients' internal financials. Do they have the right processes in place that we can actually feel good about numbers? Anecdotally, we had one client that at the end of the day, it took them almost a year to clean up their financials before we could really take them to market. Because at the end of the day, we started a quality of earnings process, like Carlos mentioned, and they just couldn't get to numbers that they could stand behind. And it took that company about a year to figure out what was going on with their books, get it cleaned up so we could actually take them to market. If that had happened in the middle of a process, I can tell you it would have been a dead process. And that would be a hard business to bring back to market later once it's cleaned up, because at that point, you've kind of lost credibility. And then nextly, all of that kind of feeds into a corporate valuation. So every time we think about strategic alternatives, right? So what are the things your client can do to really position them for maximum growth? Which again, is getting back to a lot of things that Steve and Carlos have already talked about. We want to start with a baseline. So you have a baseline projection, right? This is based off of what you think you can do or your client can do over the next 5 years. We'll do a discounted cash flow analysis, kind of your standard corporate valuation, corporate finance, public comparables, precedent transactions, maybe a leverage buyout analysis. And we'll come up with what we think the value is today. And then based on that value today, what are the things that you can do from a strategic alternative standpoint to increase that in the future, right? So it's about looking at where are we today? How do we get to somewhere much greater in the future? The strategic alternatives, as we tend to think about it, is there's the status quo. You just continue operating. You're already doing all the organic work. You're growing as fast as you can. All of your capital is going into building your business, and you have a lot of growth ahead of you. That's one, status quo. Then you could have, maybe it's selling the company. Maybe we look at it and we say there's a lot of execution risk. We looked at this, and maybe you're in secular decline. And if you don't sell now, you might have a melting ice cube on your hands that ultimately is going to be worth less in 5 years than you are worth today. Maybe it's to pursue acquisitions. Did we uncover that you have customer concentration issues? Does your client have one client that is maybe 20% of revenue, but 50% of profitability? We've seen that in the past. And can you actually use an acquisition to say, hey, we're way too exposed to Walmart, but we know we have a small competitor that has a lot of Target concentration. And so if we buy them, now we have Walmart and Target, and we look a lot more balanced. All these are things that we can think about in terms of how do they approach M&A? How do they use it as a tool in their toolkit to actually bring value to their company in the long haul? And, then there's the hybrid approaches. Do you look to actually take money off the table through a sale leaseback transaction? A lot of our clients own their real estate. And a lot of that real estate, maybe not in the last couple of months, but before was at great values. One of our clients sold his property in a sale leaseback transaction that netted him $30 million. That's a lot of risk taken off the table, right? Now he's looking at selling his business and saying, that's gravy. That's kind of, I've already de-risked myself. I'm good. My kids are good. My grandkids are fine. What do I do from here? Alternatively, you could do a sale leaseback, take that money and put it back into the business. Use that to pursue an acquisition strategy. There's a lot that you can do and think about if you have an open mind and you have some time to play with here. And then lastly, instead of a full sale, do you look at, raising some growth capital? Do you go out to, a firm and they bring in a $20 million investment for 20% of your business, and you use that to go and grow the business, right? Use that capital for high value added projects. And again, these are all things that we would look at, along with your team and other advisors, to think through how can your clients actually maximize their value over that longer term period, and try to quantify it in a way that allows them to kind of make those decisions. And so, if we look forward, then, I've got one more slide in here, and then I think we can call it. But this is really more of a takeaway. We're going to be sharing these slides so you can all kind of see all this and read this at your leisure. I think the key here, kind of as Steve said, these processes take time. At the end of the day, it's not, you don't snap your fingers, say, I want to sell tomorrow, and the business is done, you're sold. It's a multi-stage process that your clients are going to go through that takes anywhere from 6 to 9 months from start to finish. And it all kind of has to do with that question of how good is the data? How good is the business plan? How good is their understanding of where they are in the marketplace today? Because really where the time can expand significantly is in stage 1, that 1 to 6 weeks 1 to 6. Where we're doing that in internal groundwork, we're getting a Q of E done, we're doing all of that, and kind of our timing is always dictated by how quickly can the client get their stuff in order, how quickly can they actually get us our requests so we can do our work and be ready to go to market. Because once you go to market, once you begin that outreach in weeks 7 to 12. That's when the train's kind of left the station, right, for your clients, and you can't really pause. And I guess the other thing that I'd kind of put in here as well is, and how it relates to you as wealth advisors, is obviously that once the train leaves the station, there's limits on what you can do from a structuring perspective, working with your clients, working alongside T&E attorneys and other people to make sure that they have all of those things in place, so that once this process starts, they're not regretting it in stage 5, right, which is not on the page, which is moving off into the sunset, right, hopefully enjoying the fruits of their labor at the end of this process. So this is where I would say there's a very limited time for a process. It can take anywhere from 6 to 9 months. I think we show this is about 6.5 months. And making sure that you've talked to your clients well before stage 1 is important, because as you all already stated, you're talking to them about this all the time, and making sure that they understand the repercussion of not starting that planning early, I think, is probably one of the best gifts you can give to your clients at the end of the day.